Hello, and you're welcome to Global Business Insights, where you get more on the main business headlines across the globe. Eurozone annual inflation came in at 2.4% in April, same as from March, and as expected, bolstering expectations of a rate cut before the end of summer, maybe in June. MEMS stock GameStop shares plunged almost 30% as markets opened as we speak. GameStop shares down 26.3% as the video game retailer said it would sell up to 45 million shares, equal to about 15% of all outstanding shares. GameStop's shares had surged this week up at 58% higher when it closed yesterday, higher than where they were at the end of last week. Chevron is exiting its remaining assets in the North Sea oil basin, that's here in the UK, and the Dow 30 yesterday crossed the 40,000 mark. But will it continue to climb? Though it's looking flat today and under 40,000 as we speak. And in Nigeria, Minister of Finance and Coordinating Minister of the Economy, Mr. Wale Edun, yesterday clarified that the federal government had no intention of illegally tapping into the 20 trillion naira pension funds for infrastructure development. The clarification came after media reports quoted the minister saying after the last Federal Executive Council meeting that the federal government was considering tapping into the pension funds to drive investment in growth areas, including infrastructure and housing. We also take analysis on IMF and other reactions criticizing the US latest China tariffs. This morning, annual inflation rate in the euro area was confirmed at 2.4% in April 2024, the same as in March, and still at levels not seen in nearly 3 years. A year earlier, inflation rate was much higher at 7%. The numbers will inform the bank's decision as to whether to cut interest rates at next June 6 meeting. Month on month, the CPI in the Eurozone rose 0.6% after a 0.8% increase in March. In its spring 2024 economic forecast, the European Commission said the inflation is set to fall faster than previously expected and will hit 2.1% in 2025. There was a slowdown recorded in cost of services. It came in at 3.7%. Services such as hotels, which has remained at 4% since November, is something that everybody has been watching, mostly because of high wages. Non-energy industrial goods inflation also slowed down to 0.9% from 1.1%, while prices for energy continued its decline at minus 0.6% compared to minus 1.8% in March. On the other hand, prices of food, alcohol, and tobacco rose slightly more to 2.8% compared to 2.6%. Also, the core rate, which excludes energy, food, alcohol, and tobacco, fell for a ninth straight month to 2.7%, and that was also the lowest level since February 2022. Europe's economy is in desperate need of help, just marginally coming out of recession and still suffering from weak domestic demand and struggling export sector needs definitely a rate cut. Rate cuts as early as June remain on the cards, also noting that wages in Europe tend to take longer to adjust to economic conditions because they are often decided in collective bargaining agreements. Christine Lagarde, the ECB's president, has said that higher services inflation alone wouldn't delay a rate cut. She will be reassured by the data coming in today showing services inflation coming down. The Dow Jones Industrial Average was mostly flat after the blue chip average briefly topped the key 40,000 level for the first time yesterday. In the earlier episode, we featured why we think in the near term, US indices will continue to climb. Here's a clip. The question many ask is, why are US markets rallying and looking set to go even higher? I see three factors playing a strong role. First, technology innovation and competition, specifically progress in artificial intelligence, is driving fresh growth in revenues and seeing much faster potential monetization. Second, there is a monetary optimism or confidence that the economy can expect reduced cost of capital as interest rates and inflation are trending down. Kudos to the Federal Reserve policy framework, which is proving robust and reliable in its data dependence and cautious oversight rules, giving confidence that the monetary situation is well under control. And then, of course, the resilience, the evidence of a different flexibility driven by quicker corporate response to ride headwinds, even achieving higher levels of earnings performance. To the extent that all these factors reinforce each other, the likelihood is that the momentum of growth, at least in the near term, will continue to be sustained. Talking of technology innovation, let's not forget that the so-called Magnificent Seven did not become magnificent overnight, and many tech ventures have had shorter shelf life. Indeed, only those that have managed the difficult reinvention that is required to survive often hostile disruptions have stayed afloat, emerging even stronger. Looking at the early days of the Magnificent Seven, many started in home garages, incubated ideas in university labs, pointing to the importance of incubating knowledge in well-funded centers like universities and technical science platforms. Professors nurturing dreams, ideas, and theories to mentor students who could run with concepts to change the world may have been undervalued in the advances that we are presently seeing nurturing such huge results. The environment that embraced constructive failure and venture capital that forgave many experiments as young lads from garages sold their belongings, delivering the baby steps of what we see today. All these are key. Hunger and poverty nurture strife and not innovation. The existence of welfare nets that free people from fear to patiently nurture their dreams and venture capital that forgives entrepreneurial failures are all part of the ecosystem that sustains dreams until the eureka moment. On monetary optimism or the rare business confidence, the financial system needs cushions to comfortably extend credit leverage to chase the best ideas. It takes more than money to move from a garage to a $1 trillion company in 2 decades. But affordable financing, whether from relatives or helpful bank relationship manager, has helped. And on resilience in face of headwinds, as COVID stopped the clock for months, many saw opportunities in new automation, digitization, hybrid work, and far-reaching transformative ideas that would not have birthed if not for adversity. But do not expect the ballooning Wall Street rally to burst soon. Instead, countries and other markets should try and learn from factors contributing to it. We also replay a chat featuring reactions, this time the IMF reactions to the latest Biden-China tariffs. In the US, White House National Economic Advisor Lil Brennard yesterday commented at the Center for American Progress, that's a liberal think tank, that the scale of China's industrial capacity and cheap exports are hurting viability of investments in many countries. The IMF, however, disagreed with the US, saying that the US should be better served by maintaining their open trade system rather than imposing new punitive duties on Chinese goods. The IMF also urged Washington and Beijing to work together to resolve their trade tensions using established protocols like in the World Trade Organization. IMF spokesperson Julie Kozak told a regular news briefing that trade restrictions, as those announced by President Joe Biden, will distort trade and investment, will fragment supply chains, and are set to trigger retaliatory actions, obviously not helpful for the global economy. There is little that the IMF can teach the US, noting that the US wrote the rules that the IMF was set up to maintain. These rules just don't serve the interests of the US when it comes to China, and Biden is not required to explain in more detail the security issues requiring protection of US markets and citizens, used maybe as a pretext for these actions. Rather than require in vain for the US to change its approach with China on trade or to expect to bring its grievances to a WTO that is riddled with booby traps in terms of getting any speedy resolution, the IMF should understand individual country interests are equally important, especially for less prominent voices and smaller countries trying to get their fair share of global trade. At the same time, the US and China are jostling to gain the edge in a tepid trade growth scenario. And other critics have lampooned the US for poor leadership at a time many are reverting to economic nationalism, which is reshaping the globalization we know. Chevron is selling their remaining UK North Sea oil and gas assets, a move that marks exit from the aging basin after more than 55 years. This comes as Chevron prepares to acquire rival Hess for $53 billion, partially financed by $10 billion to $15 billion in asset sales around the world. The sale does create opportunities for potential acquirers such as independents seeking to grow in the UK. Meanwhile, Chevron's planned acquisition of Hess has hit a stumbling block due to a legal conflict with rival Exxon over assets in Guyana. Chevron is also confirming that the North Sea sale process is not related to a 35% windfall tax imposed by the British government after the surge in energy prices in 2022. The trend of consolidations to improve margins means older, more expensive basins in tougher fiscal environments are being sold to expand into the more profitable blocks. Higher financing costs and inflation of inputs also requiring better returns makes marginal fields less of interest for the bigger players. The windfall tax, driven by fiscal stress in many government purses, has not helped, and erosion of capacity to reinvest worsens the case to remain in basins like the North Sea. It may be time to reconsider some of these taxes. Are brick and mortar stores coming back? Online home goods retailer Wayfair is opening a brick and mortar store as we see more digital stores turn to physical locations looking for growth. This time it's a 150,000 square foot Wayfair mega store outside Chicago, and it will offer a range of home items from furniture to decor and other appliances. Looking at stocks, the Nigerian All Share Index is down 0.03%, while the Johannesburg Stock Exchange is up 0.03%. Also looking at European markets, slipping again today after snapping a 9-day winning streak. That was yesterday. DAX is down 0.17%, CAC Caron down 0.26%, while FTSE 100 down 0.22%. The markets are closed. Oil prices inching up slightly higher, still under $84 for Brent, while we see US equities still looking mixed, I would say flat really. Nasdaq down 0.01%, Dow 30 up 0.07%, S&P 500 down 0.01%. It seems analysts are figuring out what next after Dow 30 hit the 40,000 level briefly yesterday. Dow is 39,896 as we speak. And looking at some of the stocks that we're following, Wayfair is down 1.51%, Walmart slightly up 0.7%, while GameStop is down 24.09%. Well, that's it from me on Global Business Insights. This is Bode Oshasami. Please share, kindly follow on Facebook and LinkedIn, subscribe on YouTube and X. Thank you very much for watching and